Hello friends, hope you all are doing great. Thank you for joining me on this video. In today's video, we will do a summary of my 2021 portfolio performance. But before that, I need to get something off my chest. I've been seeing this horrible trend of YouTubers catching on to these trendy topics and kind of milking their subscribers and people who they have influence over just for few clicks, just for more money, basically. Why I say this is many of the popular YouTubers kind of have adopted this persona that they are with the common folks and they play up this whole GameStop thingy and just try to get more clicks. Most of them are decent, especially in the financial space. YouTubers, most of them are pretty good, so they know that most of the retail investors were going to get hurt. But instead what they did was, instead of telling their subscribers about the risk of investing more into GameStop and AMC, all the meme stocks, they kind of hyped it up. Many of them, what they did was they had live streams, and during the live streams they purchased like $5,000 or $10,000 worth of GameStop stocks, saying that I'm with you. But really what they're doing is, with that video they're making like $50,000 to $100,000. So for them that $5,000 or $10,000 is kind of like a business expense. So even CNBC was playing up this standing up with the common folks theme, everyone was milking that. And I think it's horrible because yes, the short squeeze started with the Wall Street bets, but the real squeeze happened when other hedge fund tried to squeeze them more. See, in the financial world there are no friends, though we like to say that we like to be part of a tribe and say that this is us against them. In the financial world there is no friends. Every company is for themselves. Every company, if possible, will try to get the other company out. So yes, few hedge funds lost money, but most of them made money because they also actively tried to squeeze them out, because it was dollars lying around, and everyone jumped into that bandwagon. So this whole narrative of small guy winning over the big guy, that's all story. It's nice to hear those stories, but what really happened was 5 or 6 hedge funds got hurt, but many more retail investors got hurt. Because see, even in this Reddit space, not all retail investors are the same. Everyone tried to play this common man card, but the truth is, even within the Reddit community, some of them are $1 million traders, but most of them are like under $10,000 traders, right? And all these people who got into this bandwagon of sticking up to the suit people, many of them lost money. Yeah, there are few who made money. Maybe of 1,000 traders, maybe 5 got money, but most of them lost money, right? Because people did buy in at $400 and $300 and $200, and all that money is gone. And if you read through the subreddits now, you'll see that many people lost the money, right? So I wish these YouTubers and media in general don't try to play for the gallery and kind of lose people's money. It's good to be part of a tribe when the tribe is kind of like a football team or something like that, because there is no money lost. But here real people are losing their real money, and many of these YouTubers are just milking the whole situation. So enough about that. Let's get into my portfolio summary. By the way, before we get any further, let me talk about my investment strategy. Of course, this is for anyone who is new to my channel. I guess that's almost everyone, right? So what I'm trying to build here is a dividend portfolio. I'm not expecting any great returns from dividends, at least for the time being. I trade in covered calls and spreads, and try to generate at least $2,000 a month or $24,000 a year. So this is the seed capital for my dividend investments, and my portfolio is primarily made up of ETFs, or in its final form it will be just ETFs. So let's get into this summary for January 2021. So the start of 2021, my account had a balance of 106k, and by January 31st 2021, end of the month, I had 112k balance. So that would mean a profit of $5,600, both realized and unrealized gains. The reason I say realized is because some part of that $5,600 is option premium, so it's already realized. So from a gain perspective, I had 5.27% gain versus 0.37% gain for the SPX index. I always try to compare myself with the SPX index because it's kind of like a benchmark that you can kind of try to keep you on target, because if you don't earn at least a little bit above the SPX index, why bother, right? Also, as I mentioned before, my option premium target is $2,000. In January I made $4,300, so it was kind of like $2,300 above my target. So where this helps me is because you cannot make $4,000 every month. Sometimes situation just so happens that you can make more money. In February I might make only like $1,000, right? So for the remaining 11 months I just have to make $19,000 to hit my target. So I kind of now don't have to make exactly $2,000 every month. I just need to make like $1,500, $1,600 a month now. Also, just a little bit about my portfolio. It has 30 ETFs and 10 stocks, and I use the money from my the option premium trading to buy ETFs. At this point in time, I have $44,000 worth of ETFs, and it will grow by $2,000 every month because I kind of try to deposit from the option premium $2,000 to grow this ETF account. So the 10 stocks that I mentioned is purely option play. Just keep them to make the option trades. Also, I'll just quickly go over my overall performance for this portfolio so far 1 year. That means from 2020 January to 2021 January, I have a gain of 60.97% gains against 14.32% gain for the SPX index. Also, I have an all-time gain of 77.29% versus 29.34% gain for the SPX index. So the time period I'm talking about is September 7, 2018 to January 31st, 2021. So I think a better indicator would be the annualized gain. So my annualized gain is 31.99%, pretty sweet. So this is over a period of 3 years. So each year I have an annualized gain of 31.98%. If you have more questions on my portfolio, please leave a comment. I'll try to answer all your questions. And if you would like to build a portfolio like mine, let me know. I'll try to help you. So before I end this video, let me also kind of get into this topic of whether Robinhood was at fault in this whole drama. Let me just put it out there first. Robinhood was absolutely not in fault. It's just that a lot more traders were in Robinhood. So let me explain it a little bit. So Robinhood makes money mainly by selling the order flow to market makers or high frequency traders. They also make, of course, by their gold membership, also by margin they charge on your account, but primarily they make money by selling the order flow. But this method of making money is done by all brokerages. There are no brokerages, the retail brokerages that we have now, who doesn't sell their order flow. Robinhood just decided they won't make extra money by kind of like, charging you extra for trade. Just that they thought, okay, they'll make up the revenue just by volume of traders, and which is what happened, right? A lot more people got into trading, because now you can invest $100. Before you had to spend like anywhere from $4 to $12 just to make a trade. Now, why do people think that Robinhood screwed them? That's because most of the traders were on Robinhood, not so much in other platforms like Fidelity or Webull and etc. So the margin requirement or the collateral requirement for Robinhood was quite high compared to the other trading platforms. Naturally, Robinhood could not come up with that much money as collateral. We're just talking about 2 days, but still they had to put up like $3 billion, right? And Robinhood is not lying. These are all public news. Also, an argument against this whole people kind of scheming up against retail investors in this whole GME trade is because, see, Citadel is a high frequency trader, and they wouldn't, and this high frequency trading is like their golden goose. So just for saving few $1 billion, they wouldn't mess up their $35 billion business. It's easy money, right? They already have everything set up, so they would never mess up that business just because they lost few $1 billion. Also, Robinhood is also valued at $20 billion, and why would they mess that up, right? For some market makers, and Citadel is not just the single market maker. There are a lot of other market makers. So that whole argument that they were scheming with market makers to screw retail traders is simply not true. It's good to hear, right? It's easy to blame someone. A lot more people will clap with you when you blame someone and try to be play to the gallery, but the truth is the truth. What happened is a very technical thing, and it could have happened to any brokerages if they had enough traders using that platform. Yeah, I hope if you have more questions, just let me know in comments. I can give you more technical details of what happened. So that's all I had for today, folks. If you have any questions, please let me know in the comments. If possible, please subscribe. Until we meet again, ciao.